Well, we're going to talk about the elephant in the room, and that's going to be the big Trump trade and what to expect going into this next week's inauguration. And there's no one better to talk about this, in my opinion, than with Marc Chandler from Bannockburn Forex. Marc, great to see you. Happy New Year, and what a tumultuous time we're living in, aren't we?
Yeah, Happy New Year. It's off to an incredible start this year. Trump's not even the president, but his comments have been roiling the markets.
Yes,
So,
sir.
I've been thinking about, leaving aside like the particulars for a second, trying to think what's happening in the big picture. And of course, for the big picture, I'm thinking about trade, international relations, what's happening. And I think that in many ways, Trump represents a throwback to a much earlier period. Basically, since around turn of the century, 1900 or so, the U.S. has pursued what we call the open door policy. This was really, not to give too much of a historical thing about it, but there were some notes written from the Secretary of State at the time in the early 1900s, John Hay, who was a secretary, personal secretary to Abraham Lincoln. So he's got like good bona fides. And so the question becomes, and John Hay is trying to address this. He says, looking at China, because by late 1800s, Europe and Japan have carved up China into a bunch of little concessions, like Hong Kong or the Bund district. And so the US is caught up in the Civil War, keeps us occupied domestically. But when we can go onto the international stage, China's already carved up. So John Hay writes these notes and says, we could do a couple of things. We could challenge someone else's concession that they got from China, like the Bund district. He says, or we could get our own concession from China. What he ultimately recommends is he defends the territorial integrity of China. Instead of fixed spheres of influence, and that's what they called them at the time, spheres of influence.
Spheres of influence.
Instead of fixed spheres of influence, what John Hay offered as a revisionist power at the time, let's compete for all of it. Instead of fixed spheres, let's go for variable shares. And the variability of our share is determined about our profitability, our efficiency as producers. So if we want to sell more shoes in China or more shirts or more glasses in China, the solution, John Hay argued, is not going to be getting a concession from the emperor. It's going to be keeping China whole, competing for everything. And our share of the Chinese eyeglass market or shirt market depends on how productive and how efficient we are. This is called broadly the open door. And of course, after World War I, a lot of resistance, voting against the League of Nations, for example, in the US. But at the end of World War II, this open door policy became institutionalized in things like the World Bank, the IMF, the General Agreement on Trade and Tariffs, now the WTO. This was the system we had. Variable shares, depending upon your profitability, economic efficiency. Territorial integrity was preserved. Ironically, the US was defending China's territorial integrity. Now, what does Trump say? Trump says this does not work out for Americans. Because what have we done? Because his enemy or his real threat is not so much foreign countries. It's the US economic elite. Think about like General Motors, who there was a time earlier this century where GM was making more cars, selling more cars in China than it was in the United States. A lot of cars that GM and Ford built, they're partly assembled in Mexico. Trump says nearshoring, French shoring isn't good enough. Onshoring is the answer. And he says, with all this talk about tariffs, what he says is I think it's out of context, but it's true. In the 19th century, the U.S. didn't have a tax on corporations. We didn't need one because the tariff paid for it. We didn't have free trade. Once free trade is embraced, then we need to have some other source of revenue. The tariff was the main source of federal government revenue. Free trade no longer can be, so now we introduce corporate taxes and a bunch of other taxes. Trump wants to take us back to a time where we don't pay taxes like that. We pay it through tariffs. So to me, Trump represents not, everybody. I mean, I'm sure a lot of viewers know about comparative advantage. Trump wants to say comparative advantage. It costs American jobs because there's cheaper labor elsewhere. He says so what if we have to pay more for these things, but if onshore, that creates jobs for Americans. and those jobs create demand for more goods and services, we could survive like that and thrive. So I think Trump does represent uh, a major change of course. And I think the first term was just a bit of a test of that. But I think that he's seen to have a mandate now. Both houses of Congress, control of the Supreme Court, uh, winning the popular vote. I think he's going to push harder for this return to spheres of influence over the variable shares of the open door.
So Mark, one of the things I love, I mean, there's a lot of things I love about having conversations with you, but you are a study of history, and not only you are very proficient FX analyst and have been for years, and you've always been a staple of people that I really tend to pay attention to when we're talking about the FX market and who I've appreciated for decades, but the way you study history. And it just makes so much sense to us as investors. So you believe that Trump wants to take us back to a different time, and you believe he's going to be coming out with and that's we're talking in the next week as we go into his inauguration on Martin Luther King holiday of all days on Monday. Um, you believe that he's going to come out with his gloves on and he's going to be swinging. So what does that mean for well, let's start. What does that mean for currencies and what does that mean for the dollar and how does it look like in your view going into the next, is it going to be a week? Is it going to be on Monday night? Is it going to be, over the course of the next couple of weeks? Are you seeing things?
Yeah. So first, who really knows? You know what I mean? It's like
Yeah,
who
sure.
know what I'm saying, and people who say probably don't know. And I'm probably in that latter camp where it's not like I have special insight. It's just I want to say like the gray hair means I've made a lot of mistakes. Found a lot of dead ends. And so I try to listen to like sort of rumors, gossips that are coming from my contacts in Washington. And what they tell me is that the Trump team believes that he's got 2 years, and that's before the midterm elections. So he's going to hit the ground running. And there's talk that I'm picking up that Trump has something like 100 executive orders set up for day one. He wants to hit the ground running. He's really pushed back against ideas that he's trying that his staff, his economics team, which the market seemed to like more than some of his other nominations, that his economics team looks solid. And in fact, tomorrow, Thursday, the Treasury Secretary nominee is going to be before Congress for his
And it's
for
good.
his
That's
confirmation votes.
that's going to be one of the high points of the week. It could be even be for volatility. Wouldn't you agree, Mark?
Yeah, I think that, but it sort of partly reminds me of Groucho Marx. He says something like one of my favorite philosophers, and he says something like, uh, "These are my principles, and if you don't like them, I'll change. Or if you don't like these principles, I got more." And so I think that many people want to serve in the government. They want to serve the administration. They want to I mean, like traders who have to say, that's one of the things I really respect about, especially people trading their own money. You have to say that what the market has done, and in the foreign exchange market, we're talking about $7.5 trillion a day turnover. You've got to say that that price you're looking at your screen is wrong. That's going to be different, and the direction is going to be different by whatever your time frame is. And so it requires a certain like ego, a certain confidence of one's own vision. And I think that many people who Trump has appointed have that. They want to contribute. They have a vision. I think the Treasury Secretary nominee has a vision. I think he's endorsing tariffs as a way to raise revenue because what's partly what's happening is that Trump's his old tax cuts are going to mature, are going to expire at the end of this year. He wants to extend those. But to extend them when you have such a large budget deficit, something around 6% of GDP, he's cautious about that. So he wants to use the tariffs to raise the revenue that's going to be offset by these tax cuts that he wants to renew. And so the tariffs, I think, are embraced. I think that there's little doubt. I think that there's going to be some tariffs that go into effect. In fact, earlier this week, the Alberta premier, in effect, the governor of the state or the province of Alberta, had visited Trump. And when he came back, she came back to Canada. the idea was that the tariffs would go into effect, including on oil, and Canadians should be prepared for that. So my sense is that there will be tariffs, and there's been a report that's saying that these tariffs will be gradual. I think that's just like some ideological spin. Here's why. Right now, the average, leaving aside China, the average tariff the U.S. charges on an imported good is about 2.5%. So what does gradual mean? I think the media article said that they'd raise tariffs in a sequence and maybe gradually, maybe 2 to 5% at a time. 2 to 5%, more than doubling or more the current tariff. So I don't see anything gradual about it. And I think that gradual approach, though it might appeal to some people, I think the risk is that it's sort of like it makes it harder to conduct monetary policy because every month or so you're going to get a shock. The important thing about the inflation we had is prices jumped up, they surged, and then the rise slowed down. Some prices fell, but most prices just rise at a slower rate. What's going to happen? You put on the tariffs. So in February, you put on tariffs 2 to 5%. Prices adjust to it, and then what happens? You do it again in March. Prices have to adjust again. And so I think that it would be a more chaotic situation for policy and for investors if you have this sort of this Chinese water torture, drip, drip, drip.
But okay, so I hear what you're saying, but Trump's middle name is chaos, so you got that. But at the same time, doesn't it allow his team to maybe negotiate without putting full impact on, instead of just doing a blanket 10% tariffs, giving them some time to negotiate a little bit and trying to get what they want?
Sure, yeah, no, I mean that's part of the idea, right? Is that that the tariffs would have certain conditions. Like we saw that shortly after the election, Trump says he's going to slap a tariff on, say, Mexico for fentanyl, and unless they reduce the fentanyl and reduce the immigration, the flow of people to the U.S. And here's the trick, though, I think, is that, and this is what I really have a lot of respect for the Mexican president. I think she's one of the first only leaders to say no to Trump. And she says, no, Mr. President, fentanyl, if you look at your own records, your own data, fentanyl from Mexico to the U.S. has fallen dramatically. And immigration from Mexico to the U.S. has also fallen off. That you're looking at old data. So in some ways, there's already a victory set up for him. Says, look, see, Mexico's capitulating. So they look at these inflated numbers they cite under Biden, and then they show the real numbers. They see it, things have improved. So, but I do think there's a negotiating element, but I also think there's a real element of again, it's the domestic agenda. You need to raise money to offset these tax cuts, to make these tax cuts permanent. And so I do think there's tariffs are coming, and I do think that other countries, it's sort of going to, like U.S. nationalism, is going to further excite other countries' nationalism. So you saw how Mexico responded to this idea that we should change the name of the Gulf of Mexico. The president says, listen, parts of Texas, Arizona, New Mexico, California, we should rename those to Mexico, America. Right? I mean, it's just it's meaningless in one sense. On the other hand, it just shows sort of the moxie of the Mexican president, and that countries are going to find their own ways to retaliate. Some might do it quietly. Some might try to hold out, wait till Trump's term is over. Others will have tariffs themselves. Maybe they'll have their currencies weaker. So I think there's a lot of actions other countries will do. And I think that that the U.S. nationalism is going to sort of help foment that other nationalism, which tends to mean more volatile, I think, capital markets.
So Marc, let me ask what you think the overall impact of these, policies that we're going to get. Where do you want to be? Let's talk dollars for now. It seems to me that this, some aggressive aggressive tariff policy. And let's say they choose not to do 2 to 5% and maybe adjust it on a month by month basis or a quarter by quarter basis, but you just go with blanket tariffs, and that's going to obviously strengthen, or should strengthen, the dollar. But the Trump administration has been very vocal about, JD Vance in particular and Donald Trump in particular, about not wanting a strong dollar, but they're going to have to I don't think they're going to have to. They could eat their, eat their cake and whatever they do with it too. So what are your thoughts there?
Yeah, so for me, I look at the dollar index, and it didn't begin rallying with the election. It began rallying in late September when the Fed, right around the time that interest rates bottomed, when the Fed cut rates by 50 basis points. So in this Q4 and into early this year, the dollar index has gone up almost 10%. I think a lot of good news has been priced in. Good news, that is the news that's helped the dollar. Election of Trump, what the tariffs, which not necessarily help the US, but they punish other countries. So the dollar benefits from that. The idea that Trump is not so serious about reducing the budget deficit, and that this means more treasury supply, which means higher interest rates. So I think the market has largely priced this in. There was a short window of time very early this week when the market did not have the first Fed hike discounted for this year. Excuse me, the first Fed cut not discounted until next year. We've corrected that a bit, as the markets do, it exaggerates and then pulls back to, and now we've got it back in October as the first Fed cut. So I think a lot of good news is priced into the market. I think that maybe too much good news is. I think that jobs number that we saw is stronger than expected. But one number of a number that the quality of it is so suspect these days. I look at a 6-month moving average for non-farm payrolls, and I see the economy slowing. I see this other signal. People talk about different parts of the yield curve. One that's given a very good signal is the 3-month to 10-year curve, and of course, as we've talked about before, it's not the inversion that gives you a recession, but the signal of a recession comes when the curve gets normalized again, and that's what's happened. So I still think that in the big picture, nothing's really changed. I mean, in some ways, everything's changed with the election of Trump. This going back to the spheres of influence, but in other ways, not so much has changed. The U.S. economy is still slowing. I think Federal Reserve Governor Waller, who some think could be the successor to Powell, he was pretty clear on this. That when you look at that core PCE basket, that core PCE deflator, he says most of those things in there are not rising more than the 2% Fed inflation target. And those that are not the things that we really measure directly. They're things that we have to impute, like owner's equivalent rent, for example, some kinds of financial services. And so the idea is that a hawk on the Federal Reserve, could be the next chairman, is still keeping the door open to Fed rate cuts. In December, the Fed said they'd cut rates twice this year. And I get it. It's only a snapshot in time. And here we are a month later, and we think they're outdated already. I wonder, I still would be in that camp that sees the Fed cutting. Maybe it's in the second half of the year, but I still think there's scope for the 2 cuts this year on softer inflation and on a weakening of the labor market. So to me, what all this means with the Trump stuff put in the middle of it is that a lot of good news is priced into the dollar's rally, this 4-month, 10% rally in the dollar index. Maybe we have a little bit more room to go, but I think we're at the tail end of it. And the tail end of it for me also corresponds to what's happening with rates. I remember people were talking about 5% of the 10-year. We've come pretty close to it, above 480, and we still have some more real sector data to come this week. So in the big picture, I think, the dollar's rallied, and it's rallied more than I thought. And it's gone on a little bit longer than I thought. But the inauguration is one of these things where sort of poses a possibility of buy the rumor, sell the fact. And I think we just want to wait, not necessarily the 20th day is inaugurated, but I want to give them 1 or 2 days. And then thinking that maybe this is the fact that we can begin taking some profits and looking for the foreign currencies to bounce more than they have in these last days or two.
All right. Well, then that turns. I actually want to talk a little bit about the UK economy really fast because obviously the rise in gilt yields over the course of last week got a lot of attention. Sterling, sold off near to 120. It's trying to recover a little bit as gilt yields are coming back off. We still have some data that's coming out this week with, I believe, GDP tomorrow.
Yep.
People will be watching this around the GDP data or just slightly after. Then we have retail sales later this week. Is the UK, are they going to be out of the spotlight? Can we go back to trading this more as a dollar trade versus a sterling trade? Or how do you feel about the UK economy right now?
Yeah, so I think it was a mistake for the Bank of England not to cut in December. the market feels after today's softer than expected, a little bit softer than expected CPI. Market now expects, by expect, I mean an 85, 90% confidence that the Bank of England is going to cut when they meet in early February. I think that it's really remarkable, right? We talk about the selling off of U.S. Treasuries, the higher yields that means, why that's good for the dollar. Like you mentioned, the Gilt sold off. The higher yield, though, did not help support sterling, but was really part of the exiting of the UK. You sell the Gilts, those sterling you raise, you sell those too. And that's what the market did. So where are we now? I think that part of it was exaggerated. Part of it, I think people have this memory of what happened in September 2022 with the trust problem. But this, I don't think was anything like that. It was, I'd say, not only in magnitude and duration and all that, but even in the root causes of it. I think that ultimately what's happening is that U.S. rates are rising because the U.S. economy is growing strongly still. And these other reasons we talked about, supply, fiscal issues.
All right.
So I
Well,
think the U.S. might deserve to have higher interest rates. But the sell-off in U.S. Treasuries, we live in a world in which, especially the long end of the curve, we live in a capitalist world. Partly what that means to me is that there's one market for capital. And so things trade as a proxy to treasuries or as a spread to treasuries. And I think that the UK is one of the least prepared to cope with the rising US rates, partly because the economy is weak. And that's what, to your point about the GDP, the economy has not, we're going to get the November GDP. The economy stagnated in the last 2 months. And so I think the economy is weaker. It can't hold these interest rates. The labor government sort of reminds me of that dog that chases a car. It catches the car, but it doesn't know what to do with it. Laborers wanted to become in the government. They now have the reins of government, and they don't know really what to do with it. And the budget was not well received, and they called it a bit close as far as how much room they have in case the economy were to weaken. And so, fortunately for us here in the U.S., we have access to 30-year mortgages. In the UK, they don't. So the higher interest rates from the market generated higher interest rates is going to see mortgage rates rise even with a lag, and this is going to cramp consumption. So the outlook for me for the UK economy is not so bright. It'll be a year where they really struggle.
okay. Well, that's fair enough. We have one other economy that's really struggled and is now facing the down the double barrel of a coming Trump administration, and that's China. So where are you on China, and how do you think they're going to respond to what's coming to them over the course of the next week or two?
Yeah, so I think this is a different story for China than 2016. I think in 2016 they didn't know what to take of Trump. Neither did most of us, I guess, at the end of the day. But now I think they're better prepared. China is fighting back, and I'll tell you a couple of ways they're fighting back. So we are cutting off access to advanced semiconductors and fabrication equipment for them. What they've done in retaliation is cut off chemicals, elements, minerals, metals that we need to make those semiconductor chips. They're denying us access, and because China has become the factor of the world, I think it was the World Bank or the IMF study suggesting that something like half of the world's output, manufacturing goods output, is done in China, and so they really dominate a lot of these, a lot of products, and including the ingredients for products that we need for even firing missiles. So China's retaliating by not just putting on export controls, but they're doing what the U.S. and Europe has done, which is really trying to apply those restrictions to third parties. So we say, in effect, if you have any bit of U.S., say, software or U.S. intellectual property rights in this piece of equipment, we're telling you can't sell it to China. China's doing the same thing. They say if anything that we sell to you has some of these restricted minerals or metals in it, you can't sell to the United States. So this extraterritoriality application of their sanctions, which they had not done before. So it's not just that they, like what they used to do, like when they get pissed off at like Australia, say, okay, we're going to ban Australian wine. But they're taking it a step further now. They're like limiting export restrictions, not only for Chinese companies, but for third parties. Also, people, I think that there's a lot of ideology around discussions about China. It reminds me very much of the Cold War maps. Do you remember them when we were in school? You look at the United
Yes.
States and it's the middle of the map, of course. And then to the east was Russia, just on the other side of Europe. And then you look to the west, just on the other side of the ocean, you have this little sliver of Japan, and then you get Russia again. And then almost simultaneously, it's like it's looking from the top of the globe, and you see Russia on top of us. This is a Cold War map. It's meant to excite us, to make us nervous, to make us willing to spend our tax dollars on defense. Same kind of thing is going on with China now. We pretend like China is 10 feet tall, but the reason I'm not as worried about China as maybe some other people is that one, I think China's past its peak. China's population is shrinking. The US population is not going to shrink until the middle of the century. I think think about another thing people say China, that it underconsumes. And the way they demonstrate that China underconsumes, they look at GDP and they divide GDP between basically uh, uh, manufacturing, consumption, investment. And China, of course, it has low consumption. It's around 50%, a little bit more than 50%. The US is closer to 65%. But to me, it's really just a game of mathematics, because what's the other side of that? It's investment. So to say China underconsumes, it's basically saying the same thing, that China overinvests. And I think that the overinvestment hypothesis is better because I think it lends itself to more action, more possibilities than thinking it's underconsumption. I think it's more factual. And you mentioned how the UK is going to have their GDP figures on Thursday. China is going to have its Q4 GDPs on Friday. And with the GDP, they'll provide December monthly data. And it looks to me, so if we just take it up to November, it looks to me like Chinese retail sales rose by about 3.5% in the first 11 months of 2024. US retail, and remember, the US, we say, has strong consumption. Our retail sales, 3.3%. We get that report tomorrow as well in the US. So Chinese retail sales is growing as fast, if not a little bit faster than the US is. So to say that they're underconsuming, I think really misses the real challenge. They become the factory of the world. And it's not that they just became the factory of the world. We, Americans, and partly in Europe as well, we sort of abdicated. We wanted US corporations to locate production offshore because they'd make cheaper goods. We had a tax code that allowed that. We give these companies a tax holiday. You know what they do is, so they make these foreign earnings, they keep them offshore in dollars for the most part. And then every so often we tell them, well, if you bring that money home, we'll lower the tax rate for you. Like, give them a little tax holiday. So this is a bit of a game that we've been playing, but it's not like people tell it like China stole the manufacturing capacity. I think that maybe they took some of it through uncompetitive means, but I think part of it we abdicated, we gave it up, which is why even now something like a fifth of U.S. imports that we're about to tariff, a fifth of them come from U.S. companies.
Well, Mark. So what does that mean though for China? I mean, are they going to be able to turn the ship around? I guess that's the question I have. I mean, and I know from an investment point of view, it's not like a lot of us are buying Chinese companies or anything like that, but we do trade a lot of Chinese proxies. So could this mean maybe a bottom in the Aussie dollar moving forward?
Yeah, so I find it, I think you're right. We use the Aussie as sort of this Chinese proxy, and
Sure.
sometimes it works and sometimes it doesn't. I find it works best in extremes when there's big developments as opposed to the day-to-day kind of noise.
Yeah.
But so what I think is happening? I think China's economy, I mean, they've thrown everything possibly at it. I see some preliminary signs that some of the traffic is beginning to improve for the housing market. I think they do suffer from this huge excess capacity. They cannot nearly consume everything they can produce. And so, of course, they export it. But I do think that the Chinese economy is going to recover. I think that it's sort of like yin and yang in a way, right? U.S. economy is going to slow, or we've tried to make it slow. That's what Federal Reserve's rate hikes last year were about. And China is trying to stimulate its economy. And I guess like one of these sort of rules of thumb is don't fight City Hall.
Well, fight the Chinese government either, I guess, in their stimulus efforts. So, well, that's my cue. I think I'm going to go buy some Aussie dollars then after after next week. Mark, I tell you, I've been reading your newsletter for literally 20 years now. And if you haven't done it yourself, you need to subscribe to Marc's daily newsletter that he puts together every single morning. And it comes even before I get up, which I get up pretty darn early in the morning. You get up ridiculous hours in European hours. So how do people sign up for your newsletter?
Sure. So I appreciate people like yourself who would like post a commentary. I try to avoid maybe one of the lessons is that I've often been, and you've too, probably been around people, and someone asks a question, and you see what people do. They put the first thing that pops in their head, and yet I know that we live in such a competitive world that the first thing that pops in my head, I'm getting older, might be a little bit slower than you, and it might be the same thing, but later. And so I think that to really add value, we have to not the first thing that pops in our head, but maybe the second or third thing. And so what I get up at around 5 o'clock, and I'm looking at I know what I'm looking for. I'm looking for really three things: drivers, what's driving the market, the magnitude, is it driving like beside the direction? Is it a big move? Is it a small move? And then I'm looking more specifically at the price action, like what's the price action telling us, the technical analysis. And best places I posted on morning. I do it at 6:10, like religiously, because my goal is to be in the conversations people have. I know for the banks, they typically have their meetings, say 6:30 New York time, quarter till 7. That's what I like about foreign exchange. It's an early start. And so I want to be the input into that. Partly, I think it's the division of labor. Everybody on my team at Bannockburn doesn't have to spend several hours a day reading the news. I sort of think what I do is a bit of tofu, partly digesting the news for people, like tofu being, partly digested soybean cheese. What I'm doing is partly digesting the news and basically filtering it through 30 odd years, and they have been odd, experience in the markets, and someone who's naturally curious. So best place to look is my blog is Marc to Market, but you post it on your site, and you can if you just drop me an email. If you want it to be pushed into your email box, happy to do that too. I try to use Twitter, and I'm sort of exploring a Blue Sky a little bit. I don't find the discussion there. It's not nearly as inflammatory, but it's not nearly as existent either as it is on Twitter right now. So I post something on Twitter, not only for hey, look at me, I just updated my blog. I also post some intraday commentary about the price action as I'm studying it as it evolves during the day. The best place, besides your site, would be my site, marktomarket.com.
That's Marc with a C. So, Marc, I'll tell you, like I said, you've been a staple of mine every day for literally for 20 years or more, and I want to thank you for that. And remember, you can get to Marc to Market just down below. If you click down below, there should be a link to find Marc, especially if you're on the Trader Summit website. Marc, I want to thank you for spending this time, and I want to wish you the best of luck over the course of the next couple of weeks. I do plan on catching up with you probably about a month or month and a half from now, so we can kind of dissect what has happened. But thank you for your thoughts ahead of time. I think you've better well-prepared traders for what's to come. And if you do appreciate what Marc's saying and what he's doing, make sure you give him a thumbs up, subscribe to the channel down below so you don't miss any of this exclusive content here at Trader Summit. So, Marc, thank you so much.
Thanks, Blake. Good luck to everybody. I really have a lot of respect. Most of my career I spent at banks. We're trading other people's money. But for people who have to trade their own money, I think what else can you say? There's a lot of respect for people who put their own ideas in action and live and breathe by their own ideas and their own money. So kudos to all of you.
Appreciate you, Marc. Have a great day, and good luck next week.
Thank you. Good luck to everybody.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.